Hi everyone, Chris Stanton here from the law firm of Klump & Stanton in Mendota Heights, Minnesota with my 5th YouTube video for your education and enjoyment on estate planning. Today's discussion is going to be a little bit different. It's going to center around how the state of Minnesota determines whether a person is considered a resident for Minnesota income and estate tax purposes. As you might know, many people look at Minnesota as the land of 10,000 taxes with horrible winters to boot. As a result of these small disadvantages, many people relocate to other states, particularly as they get older and they've accumulated some wealth. For years, avoiding Minnesota tax was as easy as simply being out of the state in 183 days. Well, unfortunately, Minnesota lawmakers don't miss a trick and have, through statute and administrative rules, made it much harder to avoid being taxed, even if you are in Florida for more than half the year. Now, in addition to the 183-day rule, there's now a set of 26 considerations that the Minnesota Tax Commissioner can use when determining if a person is a resident in the state and subject to income and estate tax in Minnesota. So, today we're going to talk about how to avoid paying Minnesota income tax and estate tax when you live in another state. Now, residents of Minnesota must pay income and estate tax. The key word here, resident. Okay, if you're a resident of Minnesota, there's no way of getting out of it. You have to pay the tax. The question is what qualifies as a resident? Well, Minnesota statute section 290.017 defines what resident is, and there's two different definitions. Let's start with the second one. It says under 290.017b, any individual who maintains a place of abode in the state and spends more than one-half the year in Minnesota is a resident for income tax and actually estate tax purposes. This is known as the 183-day rule. If you're here more than half the year, we don't need to look any further. You're considered a resident if you have a place to stay in Minnesota over that period of time. Okay, so that's cut and dried. If you're here more than 183 days, you're going to be considered a resident. But what happens if you're out of the state for, say, 200 days? You don't violate this 183-day rule. Well, they got covered under 290.017a, which defines a resident as any individual domiciled in Minnesota. Okay, the key word here then is domiciled. Well, what does that mean? Well, let's take a look at the Minnesota statutory definition of domicile. Okay? Now, keep in mind, this statutory definition is really a combination of physical proximity, where you are, and also what your intent is going forward. So they look into your mind in addition to where you're staying. But let's get a better idea as to what they consider. Now, first and foremost, bodily presence of an individual person along with the intent to make the place one's home. Okay? Now, what they're saying there is if you're in Florida for, say, 6.5 months to avoid the weather, and really Lakeville is your home, well, then you're still a Minnesota resident. But if really, in your mind, Fort Myers is your home and you just visit Lakeville to visit, well, that's a different story. Well, how do they tell that? Well, again, they're mind readers and they look to your intent. Secondly, place in which the person's habitation is fixed without any present intention of removal and where that person intends to return when absent. Okay, in this one, the state's looking at where do you return when you go somewhere. For instance, if you go out of the country to Europe and you come back, where do you go home? Do you go home to Minnesota or do you go home to Florida? If you go out of town on business, where do you go home? That is a consideration in determining where your domicile is. Next, move to another jurisdiction with the intention of remaining there permanently or for an indefinite period of time. That person has lost their domicile. Again, they're looking at your intent. If your intent is when you leave, you're gone. You're not coming back. It's not your intention to return or make Minnesota your place where you live in the future. And once again, they're looking at intention here as well as where you're staying. Next in line, presumption that the place where your person's family is domiciled is that person's domicile. Domicile of a person's spouse is the same as the other spouse unless there is evidence to the contrary. What they're saying here in this particular one is wherever your family is where you're domiciled. Okay, unless you can show substantial evidence to the contrary. So if your family's here in Minnesota and you're claiming Texas residency, that's going to be a hard sell because your domicile is considered wherever your family's is. Now, let's take a look at Minnesota Administrative Rule 8001.0300, which states, the mere intention to acquire a new domicile without the fact of physical removal does not change the status of the taxpayer. Nor does the fact of physical removal without the intention to remain change the person's status. The presumption is that one's domicile is the place where one lives. An individual can have only one domicile at any particular time. A domicile once shown to exist is presumed to continue until the contrary is shown. So in other words, under Minnesota Rule 8001.0300, it's a combination of where you are and what your intention is. Well, this all seems kind of funny because how do they know what your intention is? Well, the state of Minnesota, they created a set of factors in determining what your intent is for residency purposes. First, what has been considered your domicile in the past? They take a look at that in determining what your intent is. In what state do you vote? Is the person a student and where? What is your classification of employment and where? What is the location of your employment? Number 6, what is the location of newly acquired living quarters? Is it owned or is it rented? What is the present status of former living quarters? Is it sold? Is it rented? Or are you now selling it? In what state is your home being homesteaded? Do you own other real estate and where? In what state do you have your driver's license? In what state are your professional licenses? 12. What is the location of your union membership? 13. What is the physical location of your motor vehicles? 14. Do you have a resident or non-resident hunting or fishing license? 15. Have you filed your income taxes as a resident or non-resident here? 16. Have you paid the tax obligations of your resident state? 17. Where are your most active bank accounts located? Where are you writing most of your checks and withdrawing money from? 18. What is the location of your other financial institutions? What other financial outfits do you work with and where are they located? 19. Where is the location of your church membership? 20. Where's your business transacted and where do your professional advisors reside? I just want to take a couple of seconds with regard to this. I get questions many times from financial advisors. They're concerned that their clients that reside in Florida or reside in Texas or Arizona can't use them here any longer for fear of losing the residency battle. The bottom line with regard to all of this is there isn't any one factor that determines whether a person's considered a resident or non-resident. Currently, they do consider this. However, in and of it by itself doesn't cause the person in Florida to lose their Florida residency for Minnesota tax purposes. In other words, they can have a financial planner here in Minnesota and still reside and be considered a citizen in Florida. This is one of the many factors. In addition, in the last year or so, and to tell you the truth, I don't know if it's been passed, but in the last year they've looked at specifically excluding this as being a factor. In other words, your financial planner or broker is in Minneapolis and you want to claim Texas residency. Well, they've been pushing statutory changes to specifically exclude it. But to this point, to the best of my knowledge, that hasn't been passed. But again, keep in mind, it's not just this single thing that's going to determine whether or not a person is a resident of Minnesota or not. So for those of you financial advisors out there that are listening, this is just a small factor. It isn't going to be determinative as to whether or not your client is going to be considered a Minnesota resident. So you can work with people in Florida and Texas and Arizona and so on. Number 21. What is the location of your social, fraternal, athletic, and golf country clubs? 23rd factor. What is the address where your mail is received? 23. What is the percentage of time physically in Minnesota and what percentage of time spent elsewhere? 24. From what jurisdiction are unemployment benefits coming from? 25. Are family members that are attending school here getting in-state tuition? 26. Which home is insured as the primary residence? This is another factor. All of the factors, all 26 of them, are to be considered by the state in determining whether or not you're domiciled in Minnesota and as a result a resident of the state of Minnesota. Just because you may violate one of the 26 or a couple of the 26 doesn't necessarily determine that you're a resident. It's just all of these factors put together and looked at. They'll make a determination. Certainly, the more that you stay away from the state of Minnesota, the less chance that the residency issue will befall you. So, with that, my name is Chris Stanton. If you have any questions, give me a call, 651-310-1400. I'd be happy to answer them. And until next time, hope you have a nice day.